Hello, ladies and gentlemen. My name is Mark Dunn, and I'm the editor of Portfolio Institutional. I'd like to welcome you to this meeting, which focuses on environmental, social, and governance-led investment strategies, which is more commonly known as ESG. So I hope you've all logged on to the right discussion, and no one was expecting for a debate on US corporate debt. It's good, no one's left. This discussion will last for about an hour, and we're recording this, and it will appear on portfolio-institutional.co.uk, and an edited transcript of this discussion will appear on a special supplement that will be published towards the end of May. Okay. Now, before we start, I always think it's a good idea to sort of introduce ourselves so everyone knows exactly who we're talking to. Some of you may have met each other before in the course of your work, but it's always good to make sure that there's no one outstanding. David, could we start with you?
Yes, sure. Hi, good morning, everyone. My name is David Chuprina. I'm a head of ESG development at Candrium.
Anita.
Good morning. Yes, Anita Bhatia. I'm investment director at Guy's and St Thomas's Charity, which is an urban health foundation based in London, and we are manage an endowment which is roughly about £900 million in assets.
Lauren, can you introduce yourself, please?
Sure. Hi, so I'm Lauren Peacock and I work at Share Action, and we are a responsible investment charity based in London.
Good. Bridget?
Hi, my name is Bridget Uku and I'm an investment manager for the London Borough of Ealing Pension Fund, which is, well, it was 1.3 or 1.4 billion, but I've lost count what it is now.
Yeah. We'll do a count up later. Jonathan.
Hi, morning. So my name's Jonathan Levy. I'm the investment portfolio manager at the Joseph Rowntree Foundation, specifically looking after our portfolio of social investments.
Gotcha. And Stephen?
Hi, I'm Stephen. I'm Deputy Director of Ethics and Engagement at the Church of England Pensions Board. We have about 40,000 beneficiaries connected with the Church of England, and as of January, a fund of about 2.8 billion.
Last but not least, and just because she's at the bottom of my screen, it's Kate.
Hi, I'm Kate Brett. I head up the European Responsible Investment team at Mercer.
Okay, guys, thanks for that. Now, we're speaking online because the world is being turned upside down. And the financial markets, haven't escaped from that. However, one set of strategies hasn't changed and won't change, and that is ESG is always going to be ESG. And attitudes towards this particular strategy have matured. There's a lot less talk about why should I do it, and more about how can I implement it and integrate it efficiently, and of course how can I measure the results and progress to make sure that it's doing exactly what it says on the tin. So today we're going to have a little look to see exactly where the market lies. Bridget, if we could start with you, how are Ealing integrating ESG into their investment decisions and portfolio?
Well, I mean, I've been in Ealing long enough to see how ESG has transitioned over the years, where we started really with a sort of ESG agnostic board that has moved significantly along the way. So obviously we have a number of letters coming from us, from stakeholders, local council taxpayers who are constantly asking us about what we're doing with ESG. And initially it was, can you divest from tobacco? And it was more ethical. But one thing we have established is that our values cannot trump the value that we create for the fund. And one thing that we've done more recently is moved to passive investments and out of active. We have definitely taken that view that we need to go into a tilted strategy. So we've gone into a sort of low carbon customized fund. And also we're looking to maybe have more of an impact in our investment. So looking at renewables, looking at how we can invest directly in areas that will have some kind of impact as well as get returns. Also, we're very much questioning our managers as to how are they embedding ESG into their investment decision making. So it doesn't matter whether it's the bond manager, whether it's the private debt manager, or whether it's the equity manager. We're constantly questioning them as to how they're doing it. Whether it's the equity manager, making sure they're contextualizing ESG into the various sectors, because what's relevant in one sector is not relevant in another. And even for our bond managers, we're constantly questioning them as to how they're engaging. I mean, they assure us that one of the things that, one of the ways they have impact is that these companies are constantly reissuing, so they're coming back over and over, so they can exert influence that way. And even in the private markets, in the private debt, we have made sure the manager has adopted certain standards. We've made them sign up to a number of codes. We've made them hard codes of our requirements into the limited partnership agreements, and we're constantly questioning them. It's a little bit more blurred there, and it's a little bit more individual as to how they do it, unlike listed markets. But it's about asking those questions, and the fact that in local authority arena we're also pooling, it's giving us a bigger voice and a bigger impact on solution provision by the industry.
Gotcha. And Jonathan, but listening to what Bridget said there about making an impact, you're a charity, Joseph Rowntree. What's more important for you? What's top of the priority list? Making a return or making an impact, making a difference?
Well, I guess there are kind of two kind of sides to kind of look at. So, I mean, firstly, there's the endowment itself, and then secondly, there is the percentage, the small percentage of the endowment that's been carved out specifically for social investments, which is what I'm most involved in. In terms of the endowment, I mean, of course, that is, we look to make financial returns in order to finance the kind of main charitable activities of the Joseph Rowntree Foundation. But then in terms of our social investment portfolio, it is very much social returns. That is the predominant aim, with financial returns very much being a secondary objective.
Okay. And Anita, you also represent a charity endowment. Same question to you, really. Is it important for you to generate a certain target return, or is it very much on how you're making a difference?
Well, when we think about charities, I think it's quite nice to distinguish between the charitable work, the programmatic work that we do, for example, in some of the London boroughs, and how we manage our endowment. We manage the endowment to maximise returns so that we can use the proceeds to be able to support our charitable work. So the greater our returns, the more wide scale our charitable work. Having said that, I think recently we've been asking questions about how aligned our endowment management is to our mission, our purpose. As an urban health foundation, we exist to improve the lives of our place-based population and also wider. So we have a sort of we have tried. It's still work in progress. I think there's lots of scope to improve, but we have an investment policy which clearly sets out our commitment to responsible investing. We want to ensure that the managers that we invest in, because we make fund investments through our endowment, are also investing responsibly. So the ESG aspect is integrated across our endowment investments into our due diligence process, and we use it as a risk management tool. So when we go to meet managers, or when we monitor our managers, we're asking them questions about their impact on the environment, what they're doing in relation to social issues as far as their portfolio investments are concerned. And this applies across asset classes. 2 years ago, we also introduced our impact investment strategy, which is a 5% allocation from our endowment. And the objective of that impact strategy is we're still seeking those commercial risk adjusted returns, but we are also looking for impact, specifically health impact in the UK. So I think we've made some significant progress to incorporate responsible investing, to incorporate ESG considerations, and also impact in all these non-financial aspects into our financial making decision.
Gotcha. Okay. Thanks, Anita. And Stephen, what ESG metrics do you report on to your investment committee? Because this is a very broad church, of course.
Yeah. So we're a very long-term investor, and we've been an ethical and responsible investor for a long time. There are records in the church archives of investment restrictions right back to 1948. So we've been doing this for some time. In terms of ESG, the picture has evolved over time, really, as you had earlier. The original picture was about restrictions, and then from the 1970s and 80s, there was more of an emphasis on engagement with corporations in the portfolio. And more recently, we've been looking at other ways of conducting stewardship, in particular, kind of developing public, accessible tools for investors like the Transition Pathway Initiative. So for our investment committee, we report a number of things. We report a portfolio level ESG analysis, so looking right across the portfolio at ESG concerns, controversies, and ESG scores. We monitor each of our asset managers on their own. We've kind of developed a bespoke monitoring framework that incorporates climate change metrics, so the weighted average carbon emissions for the portfolio relative to that manager's benchmark. We look at the particularly poor scoring companies in that portfolio, and we use that to guide our discussions with the manager, as well as our reporting to the investment committee. There's a suite of information and kind of sets of kind of considerations that we make sure that our investment committee is across in relation to each of our asset managers. So we have the portfolio level, we have the asset manager level. We also conduct stewardship activities, active ownership activities with individual issuers in the portfolio, and we report on those and progress on those to our investment committee. For example, we lead on engagement with Royal Dutch Shell on behalf of Climate Action 100+, and obviously that's a large part of our reporting, and we put a lot of effort into that. So where we have individual stewardship engagements with particular issuers, that's part of the reporting. So right from the portfolio level through our asset managers to individual securities, and obviously we report on our screening and voting practices and that kind of thing. So it's integrated right across the things that we do, and we try and have kind of joined up thinking in relation to ESG and investment. We've integrated the team, and we're trying to integrate the thinking across what we do.
Okay, Stephen, thanks for that. David, how are Candriam's ESG strategies performing at the moment?
Well, they are performing very well. I'm very glad to report. The COVID crisis has been a true test of ESG's credential as a risk mitigating factor, or a way to reduce specific types of risk within investment portfolios. And for a long time, as you know, we have been advocating the integration of ESG and very profoundly into investment decision making, not only focusing on the environmental dimension, which is what very often everyone thinks about when we talk about ESG. We think about climate, CO2 emissions, and we might discuss later on, climate benchmarks and Paris Agreement. But the social and governance dimensions are also of paramount importance and can really be impacting companies' performance over the medium to long term as well. And this is what we are seeing today. Since we've been integrating these dimensions for a long time in many of our strategies, over 40 billion euros of funds with very deep integration of ESG, be it thematic funds or more classic fixed income and equity strategies, we were well positioned going into this crisis to resist on a relative basis the downturn. And so, yeah, to answer your question, performance is relative to peers and is pretty good.
Gotcha. Thanks, David. And Lauren, what sort of issues within responsible investment are you guys at Share Action really pushing at the moment?
Always pushing a whole range of issues, but at the moment there's a lot kind of following the crisis. There's a lot on social issues, and also about kind of transparency of companies. So we've seen a lot of companies, for example, with the crisis not have public AGMs, and we feel like this is potentially quite a risk if the kind of trend continues. Whilst it's understandable at the moment that stakeholders and shareholders can't go to public AGMs and ask questions and kind of question the board on issues. So we've been doing a bit of work on that at the moment following the crisis, just to, whilst we think it's important that there's an online aspect to AGMs, we think that kind of public accountability is crucial. So we've been especially kind of focusing on that at the moment.
Gotcha. And Kate, what kind of conversations are asset owners having with their managers and their other advisors when it comes to ESG, sustainable investing?
Yeah, we're certainly seeing a lot more conversations between asset owners and managers, and I guess with the sort of change in the regulation, particularly on the pension fund side last year, and on the DC side, they have to publish implementation statements this year, so they have to go further and effectively let members know how they've implemented the ESG policies that they set out in their SIPs last year. And so this has led to a lot of conversations with managers just around how in detail are managers implementing ESG integration more broadly, but also engagement, stewardship, monitoring in terms of impact measurements. So we have some clients that go as far as wanting both financial performance and impact metrics as well, perhaps aligned with the SDGs in some cases. Obviously that does depend on the underlying strategies and the data availability. So having a very broad range of conversations across the asset owner space. But I think there's a couple of key trends is around the asset owners are looking for much more sort of consistent data and monitoring, so particularly on climate metrics. So again, it's the government has indicated that pension funds are likely to become, or TCFD recommendations will become mandatory for pension funds in the near future. So we're seeing a lot of the pension fund asset owners try and put things in place now so that they're ready for potential regulation change. And so we're having a lot of conversations again around carbon metrics and what are the most suitable metrics that they should be looking at from a climate change perspective, and how are companies transitioning and how are those portfolios positioned. And Stephen mentioned the transition pathway initiative earlier, and I think that's something that quite a few of our clients are involved with and interested in. And again, so seeing a lot of conversations focused on that transition, but with the crisis at the moment as well, a lot of questions around how can the sort of stimulus and the kind of government packages, how can asset owners encourage that to be directed towards areas that are consistent with the climate change, environmental and other social expectations set out by the Sustainable Development Goals, for example. So
Okay.
Some very sort of top-down conversations happening as well.
Gotcha. Okay, guys, thanks for that. We're talking over the internet, as many others are having to do around the world at the moment, thanks to the lockdowns. And if you read the press and listen to politicians, this has led to an increase in cybercrime, in hacking. is this something, Bridget, asking you, is this something that maybe you're a little bit concerned about the cyber risk of your portfolio?
I guess, yes, it is something that we're concerned about. I guess, you know, it's not something we have thought about on a sort of portfolio basis, more as an authority basis. I mean, cyber risk is huge, and
yes.
I certainly couldn't get on Zoom at work because they've sort of blocked everything else apart from the Skype. So it's definitely becoming a huge concern for the authority as a whole. On a portfolio basis, it's not something we have kind of thought about too much yet. I guess, you know, no, it's not something I've kind of thought about on this sort of site for the portfolio itself or for the fund itself, but more as a broader thing for the authority.
Okay, good. Anita, how important is cyber risk for you? Has this been one of your main considerations?
It will be part, and it is part of a broad range of risk considerations that we cover as part of our operational due diligence. Yeah. And it's not something that has, it has become important because of the current pandemic. I mean, that's something that has been integrated into our operational due diligence from day one. What I would say is that, I think in terms of investors, we're quite nimble compared to many other institutions in that where we are quite active in the venture capital space. So we are focused on supporting the technology sector. And what this crisis certainly is beginning to show, if it wasn't the case before, is that that there are, in the UK and certainly globally, there's a buzzing tech startup community that are finding ways of adapting very quickly, finding new resources. There's a lot of innovation there. It's just unfortunate that the venture space is quite underfunded, undercapitalized. We certainly support that, and I think that maybe other asset owners who may not have been looking at the venture space might now be waking up to, actually, there's a lot of potential there, and there's a lot of scope to work with startups and to integrate the ESG considerations into the DNA of those startups. So there's a lot of potential to bring about change, and asset owners can be a part of that as well.
Okay, good. Stephen, how about the misuse of information risk with yourselves?
Yeah, so rather than the venture startup side, something that we've been looking at recently is the other end of the spectrum and big tech firms. We have an ethical investment advisory group that provides us with investment advice on ethical investment. Sorry, it's not investment advice, it's ethical investment advice based on Christian ethics and kind of a thorough review of issues. We've got about 20 kind of advisory policies from the EIG, and the one that they're looking at next is big tech, looking at Amazon, Apple, Google, and in particular ESG concerns and ethical investment concerns. And part of that is data governance. So we've been involved in an investment coalition around the Christchurch shooting that happened in New Zealand, where a terror attack was live streamed on Facebook, and we've been attempting to engage with Facebook on that. And we think that that has raised kind of broader issues about big tech. There are concerns around privacy in relation to the COVID pandemic, as well as just more broadly. So I think there are some interesting live questions about big tech. You know, there's antitrust concerns, obviously questions about ownership structures and the fact that the dual ownership structures don't allow the normal kind of active ownership that investors might be used to. And so there are a range of concerns that are kind of in this kind of area between ethical investment and responsible investment and ESG that have shade across the both because of the social license to operate. And I think big tech companies have and need a social license to operate. So yeah, we're kind of in the process of that review with the EIG, and I think it's something that investors are likely to be looking at more intently in the future.
Gotcha. And David, where has cyber risks fitted in with some of your clients, and where have they been raising it alongside things like climate change, for instance?
Yeah, now cybercrime is a major risk that we assess in the companies we invest in. There are at least two types of cyber concerns to consider here. They're related, but that we approach slightly differently. One is a risk around data privacy. So the risk that customer data gets leaked in the public, which can then enable hackers to use them to copy identity and proceed to further crimes. The other one is a risk around the disruption of the operations of the company itself. You don't need to have a loss of customer data for that. For example, this week, I don't know if someone has seen, but a company called Target, it's a MSCI company, so MSCI index member, announced that it was the victim of a major cybercrime campaign, and the stock price went down 8% at some point. And they were still, after a few days, they were still struggling to bring their operations back online. And this happens every week. In fact, depending which report you look at, the cost of cybercrime globally is estimated between, the range is very large because it's hard to estimate, but between $100 billion a year and $6 trillion. So this is a huge cost, and it's growing every year. So we take it very seriously when we look at the company on these two dimensions I mentioned.
Okay, moving on to more to implementation and measurement now, which are big issues for investors. Will the EU's proposed climate benchmarks for equities and bonds make it easier for investors to reduce risk in their portfolios? Would anyone like to tackle that one for me?
I mean, I think one thing it would do is it will provide, I suppose, a framework to allow us to measure the alignment of an investment portfolio. So that would be good, that there would be some kind of standard against which we can measure the solution that has been provided by the industry. But I think it won't, I mean, it will have some pitfalls. I think there will still be some pitfalls, but I think that broad framework is good.
Yeah, I mean, I would agree. I think it probably will take some time to refine as to how useful the industry finds it. But I think as a sort of first step, I think it's a good step in the right direction. I think from our perspective, we see an awful lot of these indices being developed and created, ESG branded, carbon branded, climate branded, and there's a lot of different nuances when you look at the underlying methodologies, some which are a lot more transparent than others, some that are actually quite difficult or black boxy kind of to get your head around, or very opaque in that sense. And I guess from our perspective, we also see a lot of these indices as sort of tinkering around the edges and making very small changes to something like an MSCI ACWI or a standard index. And actually, I think this is helpful because it kind of says actually you have to have made more significant changes, and particularly we're seeing a sort of increase in asset owners that want to be really Paris aligned or set net zero targets, or and I think there's a recognition that this small tinkering around the edges does not put you in that position, and particularly where we're seeing an increase in the use of passive management, it's very important that investors select the right index. So we actually think this will be quite a helpful development for the market as a whole.
Yeah, and I think it's also really important that the passive index options that investors pursue have a link to active ownership. You know, I think being a passive investor doesn't mean that you're also passive on stewardship. We've been involved in working with FTSE Russell to develop an index that does quite a lot. It goes as far and in some ways further than the EU benchmark that you've asked about. It's the FTSE Russell TPI Climate Transition Index, and we constructed it to try and avoid what Kate has said, the black box nature of some of the index tilting and weightings. We've based a significant part of the tilt and the rules around the index on TPI, Transition Pathway Initiative analysis. So it's got that link to credible, publicly available, open access academic data that's based itself on public disclosures of corporations, and it brings in meaningful tilt. So if a company is assessed by TPI on its carbon performance, which is usually its projected or committed to weighted average carbon intensity trajectory out to 2030 or 2050, if a company is assessed on that, and the sector is assessed, and it doesn't disclose sufficient information, then it will be weighted in our index at 0. So it'll be an effective exclusion. It's not excluded full stop from the index, because if it publishes disclosures that for the right kind to allow us to assess their alignment to transition, then they'll be admitted back into the index. Also, if they publish disclosures that are way out of kilter with the scenario analysis, then they get 0 weighted. And if they can demonstrate through their commitments that they're aligned with the transition to a 2-degree world or below 2-degree scenario, then they'll be overweighted in the index. So large carbon emitting companies that are aligned with the transition get overweighted up to 200% of their weighting in the index. So we think that's, the time for tinkering around the edges on passive indices are over. There needs to be a consideration of the tracking error, obviously, but we think that what's the point in tracking an index that's going for a 4 or 5 degree world? That's potentially catastrophic. So, so within our trustees' budget, bearing in mind their kind of acceptance of the principle of climate change being a systemic risk, we've kind of managed to build this and roll it out with FTSE, and we've committed to transfer all of our passive into tracking this index. So we wanted it to have rules that were clear and specific, so that we could engage with corporations and say, you're currently 0 weighted because this. If you publish the right kinds of targets and align them to the transition, you'll then be overweighted 200% in our index. And we hope that lots of other investors will find that interesting and join us, because collaborative engagement, collaborative work on these issues is really important, and the way to be effective. We're only a tiny fund, and we're not going to shift it into a FTSE 100 company or a FTSE 250 company, even just with the weight of our own voice. But together we can shift things.
Okay. Anita, when you are looking at assets, are you noticing now, because there is a lot of commentary around ESG and there's a lot of discussion around it, are you noticing actually having an impact on asset prices in terms of, well, this is quite ESG compliant, so the price has gone up? Are you seeing any impact there?
Well, I should just add that we're not making direct investments from the endowment, so we make fund investments. And I think our approach is not driven by what we see in asset prices. We are driven. We're sort of top down driven, in the sense that we're really sort of starting with our values and our mission, what's important to us, and then sort of working those values into our investment strategy. I think there is sufficient academic and scientific evidence that shows that ESG factors can have and do have an impact on asset prices in the long term. But I'm not really able to add much more to that, because it's not our focus point, but our end expectation is that if we're investing in a responsible way, taking ESG factors into consideration, in the long term, we will be able to achieve higher risk-adjusted returns compared to a normal portfolio which doesn't have those considerations.
Gotcha. Lauren, something you want to add to that?
Yes, I agree with Anita that, at Share Action, we don't really focus on kind of how ESG funds are performing, but it's actually much more about the broader picture. And I really agreed with everything that Stephen and Kate said about stewardship, and that being so important to this narrative. I think at the moment we're seeing quite a few companies come out with kind of 2050 net zero targets, for example, which is really welcome. But actually, a lot of these targets don't really include much detail into the next 10 years. And scientists have said when it comes to climate change, the next 10 years is what's crucial. So I think stewardship is such an important part of it, and it needs to be kind of more robust and more forceful, unfortunately, because it's still a little bit of tinkering and kind of gentle conversation, which isn't really enough for the kind of action we need to see on climate and the change from the business as usual that we're currently experiencing.
Gotcha. David, we just go back to what Anita said there about the research she was quoting about terms of ESG compliant investing does enhance returns over the long term. Is that something that you're seeing, or is it just about protecting the downside? Because you said that your strategy doing quite well during quite a bad time.
Yeah. Well, we think that there is a clear link between ESG quality and investment performance. And of course, this is a topic that has been on many investors' mind for some time now. And can't tell you how many times I got asked the question, I want to integrate sustainability in my investment decision making, but what is it going to cost me? And in order to answer that question, or at least provide some elements of answer, we ran a comprehensive quantitative study a year ago on a difficult asset class, emerging market equities. Difficult in the sense that in terms of ESG quality, you don't find there the same kind of reporting standards or environmental regulation that you might find in Europe or the US, that remains to be seen now. And what we found out is that over a 10-year period, so quite substantial, you can start drawing some kind of conclusions from that. Over a 10-year period, our ESG selection, so not funds, not as the result of a investment manager decision making, purely the selection based on constant and objective ESG criteria, outperformed the index by 2.4% per year over a 10-year period. And we then checked whether this might be due to some factor bias, like, for example, is maybe an ESG investment universe is more tilted towards growth, and if growth has outperformed, then of course you outperform. And what we saw is that there is no specific bias except one towards large cap, which normalized itself over time, simply because 10 years ago, when we started in 2008, there was little or less information coming from smaller companies in the emerging market, allowing us to perform our ESG due diligence. So we would leave them away, leave them aside, and that over time has become better, has improved. So we were able to integrate more mid caps, and so apart from that, towards large cap, no other noticeable bias. So really, what we learned from that, and what we've been very keen to share also with investors, is that you can generate financial alpha by integrating ESG at the heart of your investment decision making. And I'm talking here about a strategy, a universe where we, for ESG reasons, we remove over 40%, from the underlying index. So it's not just a few norms-based violations. It's much more meaningful.
Gotcha. Jonathan, would you pay a premium to get an asset that you consider to be quite ESG compliant?
I guess, we don't necessarily, I guess, kind of think along those lines in terms of our investment decision making. I mean, particularly for me, I manage our social investment portfolio and kind of actively look for new social investments. Kind of goes back to the I think the kind of first question that you asked in terms of what our kind of priorities are in terms of investing, and our number one priority certainly for social investing is to to ensure that the investment proposal aligns with the charitable objectives of the Joseph Rowntree Foundation, which ultimately is reduction of poverty and disadvantage in the UK. So that really is the kind of primary focus. And you know, in terms of returns, we want to, you know, recycle our capital, which is why we make social investments as opposed to simply making grants. We want to be able to reinvest our capital and you know, continue making more and more social impact further down the line. And you know, if we can also make a return of say 0 to 2% to kind of cover costs and so on, then you know, then that's something that we aim for as well. But it's very much the social objective and mission that has priority for us.
Gotcha. Okay. ESG integration has been typically linked to equities on the engagement side of things, of course. Now it's been moving more and more into bonds, where at the point of entry, that's when you do your engagement. Has ESG being factored into private assets, more sort of real assets? Is anyone seeing that at all, moving into those sort of markets? Kate, is that something you might have seen?
Yeah, from our perspective, private markets is actually an area where ESG can be very well integrated. So yeah, I guess it's kind of, on the one hand, assets such as property infrastructure do lend themselves very well to integration, particularly on the environmental side, and somewhat more on the social side as well in terms of healthcare. And so I guess across our investment universes, we have ESG ratings for the thousands of strategies that we rate. And actually, I can share the stats with you, Mark, afterwards in terms of the split by asset class, but infrastructure, real estate is an area where we see a kind of higher proportion of highly rated ESG strategies. So from our perspective, ones that are achieving what we would call an ESG 1 or 2 rating. Across our range of strategies, around 15% of strategies achieve one of those ratings, but in those universes it's higher. And there's a kind of somewhat of a feedback loop as well, in the sense of if you're a property strategy that's not paying any attention to environmental regulation, then you're very unlikely to be rated by us in that sense, because it's so fundamental to the success of that strategy. On the private market side as well, we're also seeing quite a lot of interest in impact investments, so kind of strategies that have an intention, and this might be in terms of jobs creation, healthcare provision, and again in the private markets it is easier to say have those conversations with companies, or more influence on those companies as to how they're developing that impact and making sure that intention remains, and you don't get this kind of drift. So on the other hand, there are still a lot of, I guess, core private equity, private debt's an area where it is difficult to integrate ESG, and we've seen some of the managers take some steps, and I know Bridget mentioned this earlier as well, and it's an area that a lot of our clients are asking for more information from the managers on, but it is one where we still see a lot of pretty low ESG ratings. So I think it is the same as all asset classes. Within those asset classes, there are managers that are doing it very well, and there's those that aren't doing it so well.
And Bridget, do you add anything there?
Yeah, I mean, I guess the difficulty we have as investors is how do we measure one manager's performance against another, because they all do it very differently. I mean, in our case, it's more the private debt managers that we're engaging with about how they're dealing with this, and they all have different ways of doing it. They all have different metrics that they use, they internally measure. So it's very difficult to compare what they're doing. My concern now is going out of COVID, a lot of these underlying companies are going to have a lot of other things that they're dealing with financially, and that they will drop the standards, all the requirements for disclosures from those companies. So really, I'm thinking about the world after we emerge from this COVID, whether that's going to impact the whole progress that we've made on ESG, because companies will be given concessions around disclosure because they'll have so many other things to deal with. Maybe we might see more of a focus on the S, because they're going to have to be concerned about the safety of their employees, about how you know, progress this 2-meter rule. So there's going to be a lot of other expenses for companies. How is that going to impact ESG going forward?
And Stephen?
So last year we began a 10-year private equity mandate with Cambridge Associates, and ESG was right across the appointment process. So from the shortlisting phase onwards, we were asking lots of ESG related questions. And what struck us, we're obviously a very early stage there, but what struck us is that GPs in private equity have an extraordinary ability to influence the underlying companies that they invest in on our behalf. They typically sit on the board, have operational involvement, so have this a great position to do ESG. What's more difficult is that you're relying on the GP to do that for all of their constituent companies, and the reporting lines are not as clear. The kind of ESG plumbing is just not there in the way that it is in public equity. Yeah, we're kind of feeling our way and working with Cambridge to put in ESG monitoring and analysis. So it can be done, and I think in private equity there's a huge opportunity, but I think it's less well developed and less standardized than it is in public equity.
Gotcha. It's quite interesting that, Anita, I mean, you're investing in funds. Bridget was talking there about information and data on assessing managers. I mean, how are you assessing managers? What sort of information are you using?
So I think there needs to be a flexible approach in reviewing the information going through managers, because Bridget is right. Information from equity managers is quite different from information that we get from our private equity or venture capital private debt managers. And I think there needs to be some open-mindedness and flexibility. So in our due diligence review, or when we're monitoring, we certainly look at different factors. So for example, if managers are signatories of an industry standard, for example, the UNPRI is really making great progress in terms of trying to encourage membership to integrate ESG principles. There are a number of other industry benchmarks like B Corp, for example. What's important is transparency, and we certainly focus quite a lot on the private market side of things. We're invested in some global equity managers who really are impressing us in terms of the information they share about their underlying companies. But I think we're seeing a lot of well-meaning initiative and effort by private markets managers as well. And we are quite proactive as well. I think there's a lot more flexibility on the private market side. So for example, when we invest in a private equity or venture capital fund or a private debt fund, one of the things that we do as part of our prerequisite is to encourage GPs to create investor advisory boards. And we take a seat on those investor advisory boards, and that gives us a voice to really speak to the impact and to challenge those GPs on their journey as they start to think about how they want to report on the ESG or the impact aspect of their portfolio companies. And it really is effective and it really works. And we've seen this with one of our private equity managers that we invested in 2 years ago. We started the journey with them on impact. They initially registered as B Corp and started going through those B Corp assessments. Over those 2 years, however, and just earlier this year, they launched their first impact report. So detailed, and when I say detail, I mean granular detail about the E, the S, and the G aspects of their roughly 8 to 10 portfolio companies. And that for me is success and achievement.
Kate, data is improving, of course, but how far has it come? Is it good enough yet? Is there still work to go from what you're seeing and what your clients are saying?
Yeah, I mean, there's still a long way to go. I mean, they're saying that. I mean, it has taken huge strides forward. So I don't want to be too negative, but I think what we're seeing though is that exponentially the data is coming much quicker, much better. Again, Bridget raised the point of it not being consistently reported or easy to compare, and again, managers face that issue at the company level as well, that data isn't always presented by companies in a comparable manner. But I think we're seeing a lot of progress through regulation, but also just asset owners really pushing managers and having those conversations and saying this is the kind of data we want to see. And again, we ourselves on one of our sustainable opportunities funds have worked with this is a private markets fund, have worked with managers to say, well, what are the key metrics that you actually look for when you're choosing whether to invest in a company, and can you report those metrics to us? And it's taken several years and of iterations going back and forth around, well, what's useful, what do the clients actually want to see, and what's useful to both sides. And but actually, when you start having those conversations with managers, they're generally very happy to oblige, and it's kind of interesting to everyone. It's another data point, effectively, to kind of look at the investment from. So I think we will continue to see a strong increase in the level of data. I think what I would caution though is you don't just want data for the sake of having data. It's kind of how it's used and how it's interpreted, and I think that interpretation and making the data clear to both the trustees, but then also then to the underlying members is very important, because we have, on the other hand, seen in some cases, and this is perhaps more on the sort of voting side as well, kind of huge reams of data being sent over to clients, and they just really don't know where to start or what to kind of pick out of that data. And I think there's a risk with presenting data to members as well, that obviously it has to be in a kind of member-friendly format. And I think there's a real opportunity for managers and asset owners as well to kind of think about what is it that the underlying pension members want to see. And I think that at the moment there's a kind of, just the fact that it's ESG data isn't necessarily mean that it's actually helpful to the underlying investors. So I think that's something that we all need to kind of keep in mind as well.
So Stephen, is enough quality data being released by companies, or is there just?
Yeah, well, I think in private markets it's worth noting that the data is used in slightly different ways than public markets, and that's because of two things. One is blind pool risk. That's what we can talk about. So that when you commit to a fund in private equity, you don't know what companies are going to end up holding. That coupled with limited secondary opportunities. So if you want to sell out of a company that your GP has bought, there are very limited, and the options that there are relatively costly. So that means that there's less that you can do with the data once you've committed to a fund. And that means that we rely pretty heavily on our relationship with the asset manager. As Anita was saying, joining investor advisory boards is a really helpful way of maintaining that relationship and providing kind of meaningful content. So the way we've thought about it is that, we're not just investing money with our private equity mandate, we're investing a lot of trust in the asset managers and in the discretionary mandate that we've got. So the kind of the methodology, I mean, data is good, and monitoring is really important, but the ESG methodology in private markets is much more heavily focused on the manager and the ethos and the capabilities of the manager, rather than kind of live monitoring of the investments that they make on ESG. Because obviously we want them to make sure that they've got good operational control of ESG risks in the portfolio companies, but it's not quite the same as the kind of ESG methodology in public markets.
And Lauren, is data something that maybe you guys have been promoting at the moment, good quality data?
Yes, certainly. So a couple of years ago, we launched the Workforce Disclosure Initiative, which is specific on the S of ESG and getting information about companies' operations and supply chains. We've seen a lot of kind of the absence of data, especially in supply chains. that is often where a lot of the risks are, and they're kind of hidden from view. And yeah, our report just came out last week actually in the 2019 data. So that's kind of 118 companies globally this year, a lot of big names submitting data in a quite detailed manner. And it's very much about, I completely agree with Kate that you don't want too much data that isn't relevant. It's about it being material and about it changing over time. You know, it needs to be kind of forward looking. So there's questions, for example, about internal hire rates and that kind of thing, which I think demonstrate how companies' policies are put into practice. I think you could have, you know, policy on diversity, for example, and that's great, but actually it's how you're measuring those indicators of how you're promoting diversity and actually improving it. And they're the kind of key data points that I think investors need. And then what Anita was saying about asset managers is really interesting as well. And I think it sounds like you've done a great job in holding them to account. And I think, yeah, we just need to see more of that conversation between asset owners and asset managers, and asset owners being empowered to ask the right questions and have the kind of data to be able to do that. So, you know, whether it's about asking how asset managers voted at certain companies or how their stewardship has impacted and affected change. Because I think if asset owners just ask, you know, oh, what you're up to on this issue, then the asset manager can easily say lots of things, but they're not necessarily kind of drilling down into the detail and being able to decipher between asset managers. So yeah, the data is key, but yeah, I completely agree with the panelists that it's about data points that are material and kind of yeah, important ones.
Okay. We're in the last 5 minutes now, so can we have the last point on data from David? I mean, are you seeing the quality of independent data improving?
Yes, definitely. And we are a big fan at Candrium of the Workforce Disclosure Initiative. And yeah, keep doing a great job. And we're very happy that, you know, first year you had about 30 companies reporting. It was 2 years ago. Last year with 19, now 118. So it's going up. And I think the Workforce Disclosure Initiative has the potential to become the CDP of the S pillar in ESG. So it could be massive in terms of impact. And certainly coming out of the COVID crisis, I hope will give an additional impetus for company to take this initiative very seriously and join it for the 2020 campaign. And more generally, the quality of data is improving also on the environmental side, but really the devil is in the details. For example, something that has been mentioned already, Climate Action 100+. So trying to convince companies to commit to some form of alignment with Paris agreements, and starting with disclosure and integration in their strategy and their operations. Well, you need to be very careful about what companies are committing to. Sometimes it looks very flashy at the first glance. And then when you look a bit further into the details, you realize that, for example, on carbon, they're only planning to reduce or even become neutral on their own emissions, not the emissions caused by their products or the use of their products. And sometimes the use of their products represent over 80% of their overall emissions. And take a car, even if a car manufacturer becomes carbon neutral on the operations, the manufacturing of the cars, if the cars is a big gas guzzling SUV, it's not really going to solve the climate issue. So that's our role as investors, through our research and through the engagement, the stewardship that we lead alone or together with other investors through, for example, Climate Action 100+ and Share Action, to make sure that when companies commit to something, it is real and going in the right direction.
Gotcha. Okay. So the time is almost up now, but a few final points. One is that with the COVID-19 crisis, the oil price at one point fell into negative territory. How is having such a low oil price going to hit the progression of renewable energy? Because the majority of energy provided to the national grid at the moment are from renewable sources. So it is gaining momentum, but you would think that a low oil price might hit things. David, back to you. Would you understand that?
Yeah. Well, one thing that people have to realize is that oil is not a source of energy to generate power. So we use renewable energy to generate power through wind turbines and solar panels and hydro installation. And in that space, oil is not competing with renewables. Oil is used for transportation, to heat up buildings, and in the industry. So in negative or very low oil prices over the short medium term don't really create an incentive to switch from renewable to oil, because you don't use oil to generate power. However, when oil price decline, you see that gas prices, natural gas prices, are also going down. And if that becomes a long-term trend, because these tend to be long-term contracts, natural gas is a direct competitor of renewables. So there you could see a lesser incentive for power generation on a cost basis to invest in renewables, but that is to some extent counterbalanced by the fact that in Europe, at least, the regulators and the government, the European Commission, are, and also in the UK and the UK government, have set a very clear path towards investing in renewables. And this is not going to change. And this is a kind of top-down regulatory pressure that can act as a counterbalance to low fossil energy prices.
Right. I think I just lost you at the end of my machine. It's fine. Does anybody else have any comment to make on the investment case of renewable energy? No, okay, fine. The hour mark is up, so we've reached our allotted time, and we have actually covered quite a lot of things there, from everything from data, from managers to making an impact. So I think we've got quite a fully rounded discussion. I'd like to thank you all for your time this morning and for your contribution. I'd especially like to thank our sponsor, Candrium, for help today. And I do hope to meet you all face-to-face on the other side of all this. So thank you very much for your time, guys. It's been great.
Thank you.
Thanks for hosting.
Thank you.
Guys, thank you.
Bye.
Goodbye.